Understanding how to navigate Canada's tax system is crucial for anyone looking to maximize their wealth and minimize their tax liability. And one of the most effective ways to achieve this is by leveraging the tax-sheltered benefits of investing and utilizing tax deductions, along with some other strategic tools to lower your tax bill this season. So this is exactly what we'll be discussing in today's video. Make sure to hit the like button and subscribe. Let's do it. Alright, so if you're looking to reduce your taxes in Canada, you need to first understand how to play within the rules of the CRA to achieve this, with the lowest hanging fruit being registered investment accounts that everyone can take advantage of. So let's start with the tax-free savings account, or TFSA for short, which is a flexible and important registered investment account available to all Canadians aged 18 or older who have a valid social insurance number. The TFSA allows individuals to contribute annually with contribution limits set by the federal government for each calendar year. And contributions are made with after-tax income, meaning they are not tax deductible. But all investment growth, whether through interest, dividends, or capital gains, that is all completely tax-free. So one of the primary advantages of a TFSA is its ability to help reduce taxes as you create income and capital gains from your investment portfolio, as any withdrawals from a TFSA down the line, whether principal or earnings, are not considered taxable income regardless of your personal income, say from your job or other sources, and which marginal tax bracket you find yourself in. Additionally, TFSA withdrawals do not affect eligibility for government benefits such as, say, old age security or the guaranteed income supplement, which can be impacted by other taxable income sources. So overall, TFSAs are ideal for various financial goals, from saving for short-term needs like emergencies or vacations to long-term investments such as purchasing a home or retirement. And by sheltering your investments from taxes, a TFSA enables your money to grow faster, making it a key component of a tax-efficient financial strategy in Canada. Of course, a TFSA though is just a type of registered investment account. If you're interested in some great exchange-traded funds and other investments that you can hold within your TFSA to take advantage of that tax-free growth, highly recommend you check out some of my other videos on the channel, such as this one right here, which I'll also link down below, that you should definitely check out. Moving on, in the registered investment account, the Registered Retirement Savings Plan, RRSP for short, is yet another tax advantaged account designed to help Canadians save for retirement. But unlike with the TFSA, contributions to an RRSP are tax deductible in the year that you make the contributions and can even be carried forward, meaning the amount you contribute reduces your taxable income for the year, most likely lowering your overall tax bill. For example, if you earn $60,000 and contribute $5,000 to your RRSP, well, your taxable income would then be reduced to $55,000, resulting of course in less tax owed. And what's strategic about RRSP contributions is that you can, like I said, carry forward contribution room indefinitely as well, and choose to make contributions to the account in years where you're earning more income and potentially be in a higher tax bracket. For example, let's say you're about to earn $140,000 in the 2024 tax year. Well, that would mean roughly $30,000 of that 140 will land in the 26% federal tax bracket. But let's say you're able to make a $30,000 RRSP contribution. Well, this would reduce your income to below that tax bracket threshold, therefore lowering your overall taxable income into 20.5% marginal tax bracket, meaning as an Ontario resident, you'd go from paying roughly $42,000 in total income tax, not taking into account other deductions, but that's a different story, down to roughly $29,500. Additionally, RRSP investments grow tax deferred, meaning you won't pay any taxes on any of the interest, the dividends, or the capital gains while the funds remain invested in the account. And taxes are only due when you withdraw those funds down the line, typically during retirement, when your income and marginal tax rate may very well be lower. Now, depending on the employer that you work for, you may have access to what's known as a group RRSP, which is similar to your traditional RRSP we just spoke about, but with certain added benefits. So a group RRSP is a retirement savings plan offered by employers to their employees. That works similarly to an individual RRSP, but contributions are made directly through payroll deductions, with the employer often matching a portion of the contributions as well. So not only do you legitimately get free money essentially from these employer matchings, which is fantastic, but you also get to utilize the entirety of those contributions as a tax deduction against your income. So it's free money on the front end, but also allowing for a larger tax deduction. Just keep in mind that your employer's contribution is added to your RRSP balance, and it counts towards your annual contribution limit. So make sure you're aware of what your total limit is to avoid over contributing. Okay, we're almost done with the RRSP variations, but we can't forget to mention the spousal RRSP, which allows one spouse to contribute to the RRSP of the other spouse, where the contributing spouse receives the tax deduction for the contributions, helping reduce their taxable income in the year the contribution is made. So this can be especially beneficial when one spouse earns significantly more than the other, as it allows the higher income spouse to reduce their taxes owing while helping the lower income spouse build retirement savings. If you're in a situation to take advantage of this, make sure to consider it, as it's a great way to save money on taxes in the short term, but also benefit your long-term investment goals. And finally, one thing to consider about the spousal RRSP, since the funds are withdrawn by the receiving spouse during retirement, if their income is still lower at that time, well, they may very well pay less tax on the withdrawal compared to the contributing spouse who might be in a higher tax bracket. And finally, for the registered investment accounts, the First Home Savings Account, or FHSA for short, is another tax advantage savings account, in this case designed to help first-time homebuyers save for a down payment. Introduced only in 2023, the FHSA allows individuals to contribute up to $8,000 per year with a lifetime limit of $40,000, where contributions to the FHSA are tax deductible like the RSP, meaning they reduce your taxable income in the year your contribution is made, thus reducing your tax liability. But additionally, any investment growth within the FHSA, whether through interest, dividends, or capital gains, is tax-free, similar to a TFSA. So when you withdraw the funds to purchase your first home, the withdrawals are also tax-free, provided the conditions are met qualifying for your first home. Yeah, so honestly, if you're actually saving up for a first home, the FHSA is absolutely going to be your best bet, as it allows for both the benefits of a TFSA and an RSP at the same time. And if you end up not utilizing the funds to buy a house, if something changes, you can transfer the balance over to your RSP. Hey, by the way, if you want to take advantage of any of these investment accounts that we just spoke about, make sure to check out my free stock market investing course over on Skillshare. It is, like I said, completely free for you to watch, has over 3,000 students and 7.5 hours worth of on-demand content. So if you're interested in checking that out, link down below in the description. And if you need to open up a TFSA, an RRSP, or other investment account, also check out Moomoo, link once again down below in this video's description and pinned comment. You can get some free money for opening up an account, and they have really low fees and rock bottom currency conversion fees. So make sure to check those out if you're interested, and let's now speak about capital gains. Moving out of the registered investment accounts, in Canada, capital gains are a form of favorably taxed income, as only 50% of the gain is included in taxable income. So this means that if you sell an investment for a profit, well, only half of the gain is subject to tax, which helps reduce the tax burden compared to regular employment income. For example, if you sell a stock, let's say, for a $10,000 gain, only $5,000 of that gain will be taxed based on your marginal income bracket. What's more though is that if you made any investments that performed poorly, you may also be able to benefit from something called capital loss harvesting, which is a strategy used to reduce taxes by selling investments at a loss. Essentially, these capital losses can come and offset capital gains, reducing the amount of taxable income from said gains. For example, if you're set to declare a $10,000 capital gain, but you also have $10,000 in capital losses, well, your tax burden would net out to zero, as these would equal each other out. That said, if your capital losses exceed your capital gains in a given year, although capital losses cannot offset employment income directly in the current year, well, net capital losses can be carried forward or backwards up to 3 years where they can reduce taxable income from capital gains in those years, effectively lowering the overall tax liability. So this strategy can really help maximize tax efficiency and minimize taxes owed if you're someone with an investment portfolio that's, incurred some losses on certain positions, which is completely normal in most investment portfolios. Just make sure to keep track of how much you're going to be declaring in capital losses so that you don't miss out on applying those capital losses to future gains down the line. All right, now wouldn't it be nice if you could invest the equity that's sitting dormant in your home while also benefiting from a tax deduction for the interest that you're paying on your mortgage? Well, in comes the Smith Maneuver. So the Smith Maneuver is a Canadian tax strategy that allows homeowners to essentially convert the interest that they're paying on their mortgage into a tax-deductible expense against their income. It works by using a readvanceable mortgage, often secured by the home itself, to invest in other income-producing assets such as stocks, mutual funds, exchange rate funds, or even real estate, while being able to use the interest that's paid on the HELOC itself as a tax deduction. The key advantage is that the interest paid on the borrowed funds used for investment purposes is tax deductible under Canadian tax laws if those borrowed funds are indeed used for investment purposes. And so this therefore allows homeowners to claim the interest as a deduction on their income taxes, which can reduce taxable income and ultimately lower the amount of taxes owed. That being said, I do really want you to understand that this is a slightly more advanced strategy that requires that you understand the implications of investing the equity of your home on a line of credit that absolutely comes with some risk. So it's very important to properly manage the risks involved with this strategy and to closely monitor the difference between the interest rate that you're paying on your HELOC and the income that you're generating from the investments, while also considering how much you're truly saving in tax along the way. One of the best investments you can make to create income while also reducing taxes owing is through real estate, which is personally my favorite investment class as it allows for just so much flexibility in ways to create a profit while also utilizing a vast array of tax deductions. Now, in Canada, when it comes to offsetting personal income with real estate losses, if you end up having any, there's no requirement to be a real estate professional, for example, unlike in the United States, where specific rules apply about having to be a real estate professional to offset your passive real estate losses from your active income that you're generating from a job. That is not the case in Canada. Rental property losses in Canada are treated as non-capital losses, which can be used to offset various other types of income, even including employment T4 income. So this means that if your rental expenses exceed your rental income, the resulting loss can reduce your overall taxable income, lowering, of course, the amount of tax that you owe. In fact, this is a situation I've personally found myself in a handful of times, offsetting my employment and business income with rental property losses, which is completely legal. Additionally, if your rental losses exceed your other income in a given year, the unused portion of that loss can typically be carried forward to offset income in future tax years. However, do keep in mind that significant or repeated rental losses may attract scrutiny from the Canada Revenue Agency, CRA. So to avoid this issue, it's absolutely paramount to ensure that the losses are totally legitimate and meet CRA requirements, and to keep thorough records of income, expenses, and justifications for these losses. And it also needs to be noted that, of course, you're not trying to create a loss on rental properties, but it's inevitable that this happens for certain years, especially when you first purchase a property and are in the process of stabilizing it. But this little trick is an added bonus that can help reduce taxes significantly. You've probably heard that investing in yourself can create some of the highest return on investments possible. And although investing in your business isn't technically an investment in yourself, well, many people's small businesses are very much an extension of themselves, as it takes just so much time and effort to make successful. This has certainly been the case for myself, where investments in my own business have created massive ROIs, but they've also allowed for business deductions that aren't really a thing if you're employed. You see, the difference here is that when you own a business, you get to deduct all of your expenses from your income, and only then do you pay income tax on the net income before taxes, which is a huge difference from employment income. Essentially, business owners get to convert a portion of their business expenses into personal expenses as deemed reasonable under the context that those expenses are used to generate income. But if you're a small business owner, chances are you're sharing a few of these expenses with your business anyway, such as potentially a portion of your home, your vehicles, your utility bills, computers, and other expenses like your phone and so on. So although easier said than done, I've always advocated for starting a business, even if you have a regular job, to supplement your income primarily, but also to take advantage and benefit from the tax and other financial advantages that come with owning a business. What's more is that if genuinely legitimate, because they have to be, business losses at the personal level can offset your employment income, reducing your taxable income and taxes owing. By the way, if you're interested in learning more about tax deductions for small business owners, and even if you're employed as well, I'd highly recommend you check out this video right here. That's available down in the description as well, right beside my free stock market investing course that has over 3,000 students and 7.5 hours of on-demand content. Don't miss out on that, or the free money that you'll get if you open a TFSA or RRSP with Moomoo, links down below in the description. Thanks a lot for watching. Subscribe. See you in the next one.